Hey guys, welcome back to the channel. In today's video, I'll talk you through the costs associated with trading, as well as the much coveted topic, how do brokers actually make their money? So without further ado guys, let's get into today's video. You don't need a degree in common sense to know that brokers don't offer their services to simply make other people money. They too have an invested interest in making profit from your trading, and they do this by charging fees per trade that you take. Let's first examine the spread. The first method they use to collect these fees is through something called spread. In order for you to understand spread, you must first have a general understanding of the terms bid and ask price. In simple terms, the bid price is the price at which you can sell an asset, and the ask price is the price at which you can buy the asset. The difference between the bid and ask price is the spread, which is the cost for you taking the trade. If you decide to open a position on an exotic currency pair at 10 PM at night, then you're likely to see wide spreads mean that you'll pay a huge commission when you open your trade, likely resulting in a huge floating loss straight away. However, if you open your position on a major currency pair during the middle of the London trading session, then it's typical to have spreads around 0.8 to 2 pips, or sometimes even less. This means that when you enter, you will only see a small floating loss. Be aware that when you're trading with larger positions, your immediate floating loss will seem larger, however this is simply down to the pip value of the spread. For example, if you're entering a position where the pip value is £100 a pip, and you have a 0.8 pip spread, then you will likely see an initial floating loss of say around £80 when you're entering the position. To calculate your pip value, you can use many online tools. However, once you understand how many pips your stop loss is and how much capital you're risking, it's a pretty simple division. If you were say risking £100 of your trading capital on a position and you had a 20 pip stop loss, you can calculate the pip value by dividing your £100 trading capital by the size of your stop loss, which is 20 pips. This therefore gives you the answer of £5 per pip. Now we can use this to calculate how much the spread will hinder our entry. Let's imagine we're trading on GBP USD and the spread is 0.8 pips. We know that each of our pips is worth £5, and therefore you can calculate the cost of the spread by simply multiplying 0.8 by £5, which would give us a £4 charge for the spread. If you were trading the same pair late on an evening and the spread say widened to 2 pips, you can see how this would have an impact on your profit and loss over several trades, as you've now gone from being on the back foot by only £4 in that position to over double that at minus £10 when you open the position. This being said, not all brokers charge spread. Instead, some will charge a fixed commission for every trade that you take depending on the lot size of that position. For example, it may be the case that your broker charges you £3 to trade a major currency pair per traded lot. This means that if you have a position that is 7 lots, or 7,000 standard units of the base currency, you would pay a fixed commission of £21. These commissions will often vary depending on the asset class that you're trading, and it's popular for some brokers to charge spread on some assets and fixed commissions on the other. If you're a scalper who looks for small moves in the market, which heavily relies on tight spreads, which don't widen during low periods of trading volume and liquidity, then you may prefer to go with a broker that uses a fixed commission so that you'll always know how much you'll be charged, regardless of whether you're in a position late at night or in the middle of the day. On the contrary, if you have a smaller account, it may not be viable for you to use a broker that charges a fixed commission per trade. Imagine your broker charged £5 per trade, and you have a trading balance of £250, aiming to make 2R on every trade that you enter whilst only risking 1% per position. You would be risking £2.50 per position and aiming to make £5 profit, which would equate to 2% of your trading account. However, if you remember the broker's taking £5 per trade anyway, it means that you're only ever going to break even on your winning positions and lose £7.50 on your losing positions. As a result of this, you've just been on a downward spiral unless you have a 100% success rate, in which case, please stop listening to this course and the 365 Days of Forex series and get yourself down to Goldman Sachs and sell me strategy. Now that you know what you're being charged when you enter and exit positions, you need to know what charges you face when leaving your positions overnight or even over the weekend, which is something that beginner traders should avoid if possible. These holding charges are referred to as swap and affect CFD traders who are trading Forex with leverage. When you're trading with leverage, you're essentially borrowing someone's capital, and therefore you pay interest on the asset that you're borrowing and earn interest on the asset that you've purchased. The swap fee comes into play when there is a difference between the two interest rates on the currency pairs, and can also be referred to as a rollover fee due to the fact that the fees are added to the position when the markets roll over to a new day. Let's take a look at an example using USD JPY. Say for example you want to open a 2-lot size buy position, which would equate to $200,000. You can then work out your swap fees by looking at the interest rates of each component currency in the pair. In this example, let's imagine that the annual interest rate of the dollar is 2.5% and the annual interest rate of the Japanese yen is 0.25%. When you're then calculating the total interest, you would simply take 0.25% away from 2.5%, which would give you an overall interest rate of 2.25%. So in total, this percentage would give you £12.32 profit per day. Be careful if you plan on holding your trades overnight or over the weekend, as you need to factor in that you'll pay swap fees for Friday, Saturday and Sunday. This can work in your favour or against you depending on whether or not the total interest rate was positive or negative. So guys, now you know the main costs associated with trading, you should be in a much better position to decide whether or not your broker is having your pants down with spreads or even charging you ludicrous commissions. So why not leave this video a like so that YouTube shows our content to more people just like you. As always, if you enjoyed the video, why not check out the other videos already on the channel in the 365 Days of Forex series. Cheers guys, and I will see you in the next one.